Good morning, everyone, and thanks again for joining us on our latest advisor webinar series. My name is Linda Johnston. I head up the investment proposition at Novia Global, and I'm delighted to say today that we are joined by LGT Vestra. And in the hot seat today, we have two for the price of one. We have Rob Hardy, who is head of strategic partnerships, and we also are joined by Olivia Wingrove, who's one of the portfolio managers at LGT Vestra. Today, they're going to be covering a variety of topics surrounding multi-asset investing, embracing emerging market trends, cutting-edge thinking, and how they incorporate that into their multi-asset investing environment, and how that can deliver optimal growth for you and your clients. So I'm sure you'll all agree that this should make for an extremely interesting presentation today. On that, if you have any questions at all as we go through the slides, there is a Q&A button at the bottom of your screen. Please just press that and submit as many questions as you like. We want it to be as interactive and as useful for you as possible. We'll run to about 25 minutes on the slides, and then we'll have a good 10 minutes or so on the Q&A at the end. So please feel free to submit as many questions as you like, and we'll go through them at the end. So without further ado, please let me hand over to Rob and today's presentation.
Thank you very much, Linda, and good morning, everybody. Absolutely delighted to be here as part of the Novia Global webinar series. As Linda said, my name is Robert Hardy. I head up the strategic partnerships here at LGT, and delighted to be joined by Olivia Wingrove, who is the lead portfolio manager for all of the international offering that we're going to be talking to you today. But investing for clients at the moment is a challenge. Historically, the environment has been quite different, and we're going to explore that a little bit as we go through. But before we get into the nuts and bolts of the investment philosophy that we have here at LGT, it's worth just giving you, hopefully for some of you, an update on who we are, and it could be a new introduction to some of you on the call today as well. As Linda said, we're LGT Wealth Management. We are a UK-based investment management company. And we were originally Vestra Wealth when we started back in 2007. And then about 3 years ago, we were acquired by the LGT Group, which is a global family-owned private bank. So this slide here very quickly shows you LGT Wealth Management, 4 locations across the UK. We're around about 500 staff now, and we're looking after about sort of close, touching on £25 billion worth of assets. The wider LGT Group is now looking at close to running 300 billion or so of assets with about 5,000 staff globally. The key thing for you all to be aware of with LGT is that it is a privately owned organisation. It's owned by the Liechtenstein royal family and has been in the Liechtenstein royal family for the last 100 years. Now, why is that relevant? Well, for me, it's pretty fundamentally relevant because you're seeing a lot of M&A activity in the market, certainly in financial services at the moment, whether it's discretionary fund managers being bought, whether it's advisory firms being bought, whether it's life companies buying life companies, platforms buying platforms. There's a huge amount of consolidation and M&A activity, which, don't get me wrong, that can be a positive experience for you as advisors. It can be a positive experience for your clients. But at the same time, it can create uncertainty. They can be quite disruptive events. So we sit here today very comfortable in the fact that we're owned by a family-owned business that makes long-term strategic decisions based on the best interests of our clients and our staff. And at no point is there any risk that you're going to wake up and see in the headlines that LGT Group has been acquired by a private equity firm or a consolidator or a life company or anything like that at all. So that security, that confidence that the structure that we have means that you can rely on us to be around for the future. Now, in terms of the investment process that we have at LGT, we are a multi-asset investment house. We do not run single strategy funds, whether it's equity funds or bond funds or commodity funds at all. We are all about multi-asset investing. And this slide here is probably one of my favourites. You may have seen me use this before, because it really does highlight and underpin, I think, the conversations you have with your clients about the benefits of diversification, the fact that putting all of your eggs in one basket is never a good idea, and actually spreading your risk across a range of different asset classes. And what this shows in a nice picture colourful way is for the last decade, and you've got the best performing asset class in each given year at the top, and then the worst performing asset class at the bottom. And the first thing that immediately jumps out at you is that there is no correlation between any given year and any given asset class. So having a spread of all of these is naturally the right thing to do when it comes to investing your clients' money. And what we do here as well is the black boxes pretty much running through the middle are the LGT Wealth Management balanced model portfolios. And exactly as you'd expect for a balanced investor, those black boxes pretty much trend through the middle. And over that decade from 2011 to 2021, the balanced portfolio gave an annualized return of just over 8%. I mean, if you're a balanced investor and you started your journey in 2011 and you had that 8% annualized, that would have been a very positive investment journey for them. So that's what we're all about as investors. And Olivia is going to draw out some of those key themes that we're doing when we're thinking about portfolio construction, how we're taking this matrix of different asset classes and how we're implementing that in our portfolios. But the world has been very different in the past. And I think this graph really articulates that very clearly. Back in 2009, I'm sure all of you on the call today will remember that. That was the great financial crisis. Lehman Brothers went under, and central banks had to step in, governments had to step in to shore up the banking system to ensure that there wasn't a complete financial calamity. What that entailed was huge amounts of quantitative easing being pumped into the market. Interest rates went through the floor, right down to zero that we've seen until relatively recently. And that really was the landscape for the next decade, up until the end of 2020. So if you were an investor back then and you were investing at the beginning of 2009, 2010, your investment journey, as long as you had risk in your portfolios, has been very, very positive. And what you see here is you've got the FTSE 100, which is the worst performing one along the bottom there. You've then got the S&P 500, which is the black line. And then you've got the NASDAQ or the tech index there in gold. And really, if you held equities, you did well. But the more exposure you had to the US, and more importantly, the more exposure you had to tech stocks, then that effectively turbocharged the returns that your clients would have received. And you saw some huge returns coming from those US-focused, tech stock-focused portfolios. Next slide, please, Katie. And then what happened was in late 2021, there was that sort of rotation away from growth stocks into value stocks. We saw inflation creeping in, we saw interest rates going up, and that caused a big change in market sentiment. It caused a big change in the investment landscape as well. And as a result of that, with interest rates going up, bonds values plummeted in 2022. Widely commented that the fact that in 2022, that was the worst performing year for bonds pretty much in 100 years. Huge negative returns. At the same time, the equities underperformed and had a downturn as well. So if you had a traditional balanced portfolio, which is typically a 60% equity, 40% bond portfolio, your clients had a very, very difficult year. That was also compounded by the more cautious end of the spectrum. So your more cautious clients, which would have typically held more bonds, they would have suffered even more as bonds really did get hammered in 2022. Going forward, though, the landscape is difficult. And this again shows those three equity indexes that I've just highlighted, the FTSE 100, the S&P 500 and the NASDAQ. You see the NASDAQ, that tech-focused index, was the worst performing as you went through the end of, into 2021 up until the end of 2022. That 2 years, the NASDAQ suffered quite heavily. And obviously, the beginning of this year, it has improved slightly, but it came off quite significantly. By contrast, the FTSE 100 started to do much better, which was the best performing index over that 2-year period. But what this is showing is that the landscape we've had historically for that decade post 2009 to where we are now is a very different world that we're in now. And of course, we as multi-asset investors have to look at the world differently, and we have to adjust our portfolio implementation as a consequence. But one thing we've always been very good at here at Vesta, as we were, and now LGT Wealth Management, is our response in terms of the proposition that we have, in terms of solutions that we offer to financial intermediaries, both in the UK and now increasingly around the world. So this gives you a timeline in terms of that evolution. Culminating, as you see there, in 2023, which was actually, this development went live on Monday this week, where our new multi-asset offshore investment range out of our Dublin ICAV went live, was signed off by the CBI on Monday this week. Exciting news for us. But that gives you a timeline in terms of the proposition evolution over time. Just to quickly summarise what it is that we offer for the offshore expat advisory market, we have a range of offshore model portfolios, international model portfolios denominated in sterling, euro and US dollars across five risk profiles with a strategic income portfolio as well. Those are off the shelf and available via all good platforms, specifically Novia Global, obviously, and are getting wide traction amongst the expat advisory market. They've got a good 5-year track record sitting behind them as well, so that's available for you to look at. We also offer bespoke portfolio management. This is for us, typically the high net worth clients that want to have a bespoke investment manager building a bespoke investment portfolio for them. And there's a range of ancillary services that sit within that in terms of lending against portfolios. We can custody clients' portfolios in a range of jurisdictions around the world. We can run the portfolios in different currency denominations as well. So it really is what you'd expect from a truly global private bank. We then have a range of international sustainable model portfolios as well. As Olivia will come on to talk about in a bit, sustainability runs right through the central core of the LGT group and in LGT Wealth Management here in the UK. Not only in terms of the sustainable investment solution that we offer, but actually how we function and how we operate as a business. There's a whole separate presentation on that, so I'm not going to go into that detail right now, but that's something that we are firmly behind. And then there's additional things such as our US Connected service as well. A lot of you in the communities and the expat communities that you're networking and operating in, you come across a range of expats. Often a lot of them will be UK, but we know from experience that you do come across a lot of US Connected parties as well. We, as an investment management firm, have a US business, LGT Wealth Management US here in the UK, and we are fully authorised by the FCA and also the SEC to run portfolios, investment portfolios for US Connected clients. So if that would be of interest to you, then by all means do get in touch. And exactly as I just said, now available will be the International Volare Multi-Asset Funds, which, as I said, got signed off by the CPI Monday this week. Exciting news for us. So I'm now going to pass over to Olivia, who's going to talk about how do we go about capturing those global opportunities within multi-asset portfolios.
Okay, thanks,
Olivia.
Rob. Yes, so a lot to cover, but I'm going to take you through a little bit of our investment process for those that aren't familiar with it. And then I will just touch on how we utilise different tools within portfolio construction, such as active and passive funds. And then finally, I'll talk about our role really as multi-asset investors and how we are tapping in to long-term structural opportunities within markets and really ensuring that client portfolios are future-proofed. But before I do that, if I start with our strategic asset allocation, and I think really the point to make is that whichever international proposition you're accessing or you're using us for, it will be a reflection of our central investment process. So whether it's the sustainable portfolios, the core portfolios, the funds, bespoke, whatever it may be, it will really be utilising the output of that central investment committee. So that committee meets every month over 2 days. The first day is very much number crunching, looking at the macro environment and data and assessing whether or not our views have changed on the current market environment. And then day 2 is really, it's called the implementation meeting. It's when we look at the portfolios and we think about whether or not we want to make any changes, and a huge amount of external research alongside our dedicated equity and fund research analysts goes into these meetings to really guide our discussions. But we start with our strategic asset allocation, and I think this slide is quite useful just to visualize what we mean by that. Obviously, Rob alluded to the 5 strategies that we have within our international offering. So those range from adventurous, growth, balanced, cautious, and defensive, so across the risk profiles. We have ranges for the equity allocation, and we have a neutral, which is really what guides our kind of tactical positioning around it. So if we take the balanced, for example, so if we just go on to the next slide, what you can see is you've got a range of 35 to 70 for a balanced portfolio within equities. It's very unlikely to get up to that 70% mark. The neutral weighting is 50, and at present, we're sitting around 55% in equity for a balanced client across the various international offerings that I mentioned. So I think in terms of our current positioning, over the last 12 to 18 months, we've been reducing equity exposure within portfolios in the light of the current market backdrop, a higher rate environment, a lot of market volatility. And so you've seen a sort of steady decrease in equity exposure within the portfolios. So across the spectrum, currently we're about 10% overweight our neutral weight with equity within equities. And we've been allocating to other areas of the portfolio, such as alternatives and deploying cash balances where possible, while cognizant of the fact that we can achieve a quite comfortable return on that cash position kind of in the short term. So that's a little bit about our strategic asset allocation. But if we go to the next slide, and I want to talk about really the key tenets of our investment solutions. And I think it's really important to sort of talk about these together, because they all form the bedrock of our portfolios here at LGT. So we are known for taking a high conviction approach to active management here. We have a dedicated research team, and we build portfolios primarily using the active recommendations from this team. And so our portfolios take a best ideas approach across style, across regions, and across sectors. But we also recognize, as Rob's discussed, that the market has changed over the last 10 years with the advent of passive, and with that we have evolved our process, and that's something we are very proud of. We like to adapt and change with time and be responsive to a changing market environment. So while there is a lot of debate around active versus passive, we believe that both really play an important role within portfolios and serve different purposes. So you have the active management, which provides portfolios with attractive alpha opportunities, and we're able to take advantage of those through arbitrage and through share price dislocations. And really our role as active managers is to seek out those winners. And you may hear statistics that 70% of active funds don't outperform the benchmark. Our role, and the reason why we have those dedicated research analysts, is to identify the winners. And it really is in tougher periods of time that you see that you really need the benefits of active management, and where active managers are able to exploit those market dislocations and have the freedom to make those unconstrained investment decisions that really make the difference between positive and negative returns in a market cycle. But we do believe that passive funds provide a really important broad market exposure, so market beta, with crucial style agnosticism and low cost. And I think that is a really important point to mention. So we use passive exposures within the portfolios, particularly within areas like the US and global equity, to gain that broad market beta exposure. But as I said, our value add as multi-asset investors is really being able to select these active managers and blend them with the passive, so really portfolio construction, to create a well-balanced and cost-effective portfolio for your clients. But then the third point is really kind of one of the most exciting areas, and it's really about positioning our portfolios for the long term. And despite the sort of short-term market noise and the cyclical factors that are driving performance, we want to ensure that we're well positioned for the longer term, and in doing so that our portfolios are future-proofed. And many ways that we do that is by identifying the structural megatrends that we see as kind of defining the market over the coming years, and trying to allocate capital towards those trends. So I'll come on to many of these, but I think I'm going to focus for today on the energy transition and sustainability, which Rob mentioned is at the core of our investment solution. So if we can just go on to the next slide. We're all aware of these themes. I mean, they won't be news to any of you. If we start with AI, it certainly dominated the headlines this year with the launch of ChatGPT earlier in the year. I think the reason why these megatrends are important, not just because they're buzzwords or they're seeing significant talk on social media, but it's because they have the ability to significantly impact the global economy. And that's really important regardless of the cyclical forces at play. They will drive the returns in the market and significantly disrupt many of the businesses that we know and own today. So our role is really to identify the opportunities that come out of these long-term megatrends associated with AI, associated with emerging markets, and provide exposure to them within client portfolios. So, I mean, if I take AI, aside from the hype that we've seen, NVIDIA is probably a name you're familiar with. It makes graphic processing units, but also the so-called Magnificent Seven. So, you know, your Meta, Amazon, Facebook, all of the likes of those. You know, at one point this year, we had 10 stocks driving 82% of the S&P 500's return. So all of those stocks, aside from the fact that they're extremely cash generative and diversified businesses, had exposure to AI. And while this was really exciting, we certainly believe that AI is a very powerful force within markets and has the potential to really enhance productivity. We also had some concerns about the narrowness of the rally within those 7 stocks in particular. And I think, again, it goes back to that point about being active and being able to be a little bit more cautious, particularly in the early stages of investor exuberance. And we have since seen that rally broaden out, but I think it's important to think about the theme and think about not just those 7 technology names, but also where AI is shaping certain areas of the market in healthcare, for example, diagnostics, transportation, electric vehicles. These are all things that are also beneficiaries of AI more broadly. The energy transition is another example. I mentioned electrification, but it's significant for decarbonisation. And so looking at the theme broadly and then working out how we want to tap into it within the portfolios. So it really comes down, when we think about these long-term megatrends, to the ability to redirect capital towards newly created productive areas of the market. And AI is one where we can be confident it's going to boost productivity and the pace of innovation, but we want to make sure we're selective within our portfolios to ensure that we're not just tapping into sort of 7 technology names. But I think what's really interesting, and I won't go into all of these in detail, is just how much of these themes are very interlinked in the world that we're in today. AI is a huge opportunity set, but it also levels the playing field for many emerging markets and developing economies and providing efficiencies. And I think, again, that links in with the energy transition and with sustainability. Things like precision farming, crop management, these are all outputs of AI that are hugely beneficial for emerging markets and companies that are driving energy transition. So there's a lot of moving parts, everything's very interlinked, and I think that's quite important within the portfolios. You've also got friendshoring in there, but that is this idea of many companies diversifying their supply chains out of China, and that is hugely beneficial for neighbouring economies like India. So Apple's a perfect example of aiming to produce 25% of iPhones in India by 2025. Now, question of whether the infrastructure is in place is there, but India is a key beneficiary of this friendshoring trade and this idea of many businesses wanting to kind of diversify their supply chains. So I'll come on to emerging markets in more detail later, because I think we've had a question through on that. But certainly it's an area of focus within the portfolios today. But I'm going to go on to a little bit more detail on the energy transition, because I think, what do we mean by this? First of all, it's really this move away from the use of traditional fossil fuels and carbon to a low carbon economy, and one where we're utilizing renewable energy. So I think it's something that we're all aware of in our personal lives, is the climate emergency that we're facing. And I think regardless of your stance on sustainability, on ESG, I think it's an undeniable change in the way that we live. And from an investment perspective, it provides a significant opportunity set, particularly for those companies that are enabling decarbonisation and disrupting the traditional kind of fossil fuel and ways of energy production. So ways that we gain exposure to this theme of the energy transition is through some of our high conviction active managers. And I think it goes back to that point of active management. A great example of this is the 91 Global Environment Fund. That fund is held within our sustainable portfolios, but also within our fund. And it's a fund that invests in companies that are tapping into sustainable decarbonisation. So driving the transition to a low carbon world and set to benefit from the energy transition. So a good stock example of this is NextEra Energy. It's the largest owner of renewable energy in the States. And it really is helping to drive that transition through a sustainable energy grid. Another example of a fund that we hold within the portfolios is the Impacts Asian Environmental Markets Fund. And this is a global small and mid-cap fund. So it's very sort of, this is the sort of fund that is really useful to hold alongside kind of a core passive exposure to global equities. This fund is small and mid-cap. So it's got a high active management. It's focusing on pure play resource efficiency companies and environmental markets. And it's tapping into businesses that are able to disrupt the current market in renewable energy. So all of these themes that you see here, electric vehicles, we've obviously spoken about AI, that's a key beneficiary there. But renewable technologies and air pollution and the circular economy, these are all outputs of the energy transition, and we're aiming to get exposure to these within portfolios. But if we go on to just the next slide, because I think it's important to really go back to and to stick to our knitting, really. The current market environment, as Rob said at the outset, is very different to the one of the previous decade. I think active management plays an increasingly important role. Obviously, when financial markets are performing well, you've got low interest rates, you've got consumer sentiment high. Companies and share prices are buoyed by this, and even businesses that are highly leveraged and actually are poorly run tend to benefit from the sort of the positive trajectory in markets. But we are now in a very different market environment, one of high volatility. I mentioned higher rates, and actually we're starting to see that dispersion between the well-run and the badly run companies. And the winners in this environment are those quality businesses, those that are investing in technology, that are embracing change with pricing power, monopolistic control, strong balance sheets, all of these things, all of the factors of quality that ensure that businesses are able to kind of withstand the market environment that we're facing. And that's not a new approach for us at LGT. We've always geared the portfolios towards these quality businesses. And as you can see on the right-hand side, this is a Morningstar style chart, and it shows the LGT Wealth Management Balance portfolio here in the UK, because that's got the longest track record, I think from 2008 or 9. Over sort of 15 years, you can see we've always been in that sort of middle to right-hand style quadrant, which essentially means that while we might move the portfolio slightly over, to reflect different market environments, we're not kind of swinging the portfolio around based on gyrations between value and growth. We like that sort of core quality approach, and that has really benefited portfolio as well. And you can see on the left-hand chart the divergence in returns for the MSCI World Quality versus the MSCI World. And it really goes to show the value in holding those active managers, freedom to pick the stock winners. While passive funds do hold these quality names, they will also have exposure to those businesses that may not be as resilient in the current market environment. So very important to blend the two and to not be solely wedded to one particular style or segment of the market. So looking forward, we believe that kind of our current approach with this blend of active and passive, but also really long-term thinking about kind of tapping into those sort of structural trends within the markets leaves the portfolios very well positioned across the spectrum. And I think I'll probably stop there in terms of how we construct the portfolios and go on to sort of any questions if we have any.
Thank you so much, Rob. Thank you very much, Olivia. I'm sure you'll all agree there were some really interesting points that were raised there. And as you can imagine, we have had a couple of questions from the floor. The first question I'd like to address is probably for you, Olivia. Touched upon your various elements with AI, etc. And then you mentioned about emerging markets. So someone had put an early question in about your emerging market view, and how do you see that playing a role in the future of multi-asset investing?
Yes, so I mentioned obviously we're positive on emerging markets, and we have been for a while now. I think, you know, we certainly believe that a huge amount of the growth within the global economy is going to be driven by EM. But I think it's really important to think about, you know, how we what we mean by EM, because it's very broad. There's a lot of huge economies within emerging markets. You've obviously got the big players, China, India, Brazil. And if I start on China, for example, you know, there was huge talk at the beginning of this year about reopening of the Chinese economy, and actually that has disappointed markets. We've seen a nervousness from the Chinese consumer. We've seen perhaps a little less stimulus from the government than we were expecting, and to boost the economy. And really that's kind of fallen a bit flat. But many of our active managers are still very positive on the region, and we certainly believe that China, particularly when it comes to things like renewable energy, there's a huge amount of kind of positive factors going into the Chinese economy. However, we believe that the neighboring economies like India, I obviously alluded to that earlier, Brazil as well, are going to be key beneficiaries of this sort of de-sinification trade. But also more interestingly are the lesser known and the lesser spoken about countries within emerging markets, your Vietnam, Malaysia, Thailand, Mexico, Argentina. They're all ripe for kind of benefiting from many of these attractive themes that we've spoken about today. So and one of the reasons they are is because they've got large, flexible labor markets, abundant resources. One of the issues that the developed economy is facing is scarcity in energy, in resource, in labor. And actually what we see is the flip side of that in these economies. And so one of the ideas that we're speaking about a lot at the moment is the idea of allocating to a kind of next generation emerging markets fund within portfolio. We think that this could present a really attractive opportunity. And again, it highlights that sort of active management within emerging markets. I think a good example of this is one of the funds we hold within portfolios is the Schroeder Asia Total Return Fund. Now, this is a fund that's held across the portfolios. The PM is based in Singapore, but he's supported by 38 dedicated research analysts on the ground across 7 Asian economies. And that really highlights that sort of expertise that we are tapping into, really trying to gain exposure, which you can't seek through just purely a passive fund. So I think we're positive on emerging markets. We're selective under the bonnet. But one of the things to remember at the moment is that many emerging markets are ahead in the monetary cycle. They're easing, and therefore we think that you know, we're well placed to benefit within portfolios from the positions that we hold.
Yeah, thank you. We've had quite a few questions, so I'll get through them all. So one of the other questions we've had is if you could elaborate a bit more on the tech and the data analytics being leveraged in multi-asset investing. So how does this impact your decision-making process?
Yeah, I mean, I think it goes back to the sort of point on AI and how it is, you know, really benefiting our ability to research, to do our jobs. And I think in terms of data analytics, there's sort of pros and cons. I mean, one of the things that we talk about a lot are the risks surrounding AI and data analytics, and actually some of the cyber attacks that we're seeing. There's a lot going on that we need to be careful about. But in terms of the sort of software, the kind of the enhancements that we're seeing in terms of the research that we're able to do, and we certainly utilize a lot of different tools within our team, particularly on the sustainable side. We have our own proprietary tool called SMAX, which uses a lot of data. We have an entire team that look after our sustainability data now, which is a huge change from 5 years ago, when you would have been doing more qualitative research on these companies. A huge amount of work that we now do is looking at the data, using a lot of code, Python and the likes, and plugging that into our internal tools. One of the ones I alluded to is SMAX, and that looks at the revenue generated of all of the businesses that we hold, and is able to align the exposure to things like the energy transition, for example. So technology and data analytics are hugely crucial to multi-asset investing. However, there are risks involved, and so we're just cognizant of things like cybersecurity and areas like that.
Yeah, just to elaborate on that point slightly, the SMAX tool that Olivia was talking about, one of the really good example of where we use that is when we're talking to fund managers that run sustainable portfolios that we might be interested in terms of whether they would be appropriate for our model portfolios or our unitized solution. What we can do with that tool is we always demand a complete breakdown of the fund manager's portfolio. So we have full disclosure. We want to see every single holding that the manager holds. And then we can take all of those holdings and we can put them through this proprietary piece of technology that we built. And there's a way, the benefit of that is we can sense check what the portfolio manager is saying in terms of what his ethos is for the fund, what his stock selection criteria are, what his benchmarking is. And then we can take all of those stocks out of it and put them through our own tool. And that gives us the ability to independently assess whether what his messaging is for the fund and what his criteria are is actually being delivered in his stock selection. And there's been various examples over the years where certain stocks within a fund manager's portfolio have been highlighted as, we believe, not appropriate for that fund. And it gives us the opportunity to then go back to the fund manager and challenge and say, why are you holding this particular stock? Because based on your criteria for your fund, that holding should not be in there. And that either leads to one of two things: either there's a very good justification for it, or the fund manager sits there sort of with his mouth open going, in which case the fund doesn't get put into the portfolio. And that's a really big topic, I think, for not only for advisors, but for researchers, manager researchers such as ourselves, is being able to see beneath the marketing side of an investment solution and actually delve under the bonnet, and being able to do so in a much more technical and analytical basis.
We've got a couple more questions we'd like to try and get through. And you mentioned when you were talking earlier, Olivia, about risk, and one of the questions is, how do you balance the pursuit of mega trends, emerging latest trends, with the need for risk management, some stability and performance in your portfolios?
Yeah, I think it's a really important approach, because we've obviously spoken a lot about the equity component of portfolios, and obviously the equity component is there to provide capital appreciation. But we haven't really touched upon fixed income and the role that plays within portfolios, and obviously it's there to provide that ballast, to dampen volatility in times of market stress. And so I think the first area that we use for risk management and stability is fixed income, and certainly within fixed income we take a very active approach to our underlying exposures. So whether it's ensuring that we're geared into the kind of high quality sovereign debt, alongside utilizing strategic bond managers, for example, who are able to kind of tap into certain parts of the curve we take a bit more of a sort of a barbell approach there. So we've got that sort of, if we want to increase duration, it would certainly be only using high quality government bonds, but in the shorter term being able to tap into some of the more high yielding but again high quality exposures of the market. But that portion of the portfolio is very much there to provide that ballast and to cushion some of the volatility that we do see within equity markets. But also important to draw attention to is alternatives, and certainly at LGT we utilize alternative managers within our multi-asset portfolios. A great example is the Trojan Fund. This fund it holds a significant portion of its portfolio within gold, and we like that. That's very much been our hedge against a hard landing scenario. That fund performed very strongly when we saw, sadly Russia invade Ukraine, but it very much provides that exposure to gold, that safe haven kind of asset of gold within portfolios. And again, it's got access to things like US tips and other areas of the market. So alternatives certainly is an area that we allocate to alongside fixed income. But in terms of risk management, when I mentioned things like tapping into emerging markets and tapping into some of these mega trends, it's certainly not kind of wholesale huge parts of the portfolio. The portfolios are very diversified. You typically see around 25 holdings within a portfolio. So where you do see exposure to emerging markets, it tends to be within the higher risk strategies and small allocations alongside the kind of core of our portfolios, which is in those more global equity managers, and then they tend to have a bit more of a core approach as opposed to sort of a sort of high beta type approach.
So thank you very much. And then one or two last questions. What are some of the main challenges you've encountered with the recent investment landscape? What's coming next that we should be worried about?
Yeah, I think this is a really fascinating question, and I think it's a question that a lot of people have been asking over the last few years, really. Ever since we moved out of that decade of, well, all you had to do was buy equities and you got good returns. The landscape, as we've been talking about, is fundamentally different. So you're getting really attractive yields on bonds now. Getting a 6% yield is relatively easy for fund managers to do. That's a positive. The potential downside there is that have interest rates got higher to go? Is inflation getting under control? Those are still some very big unknown questions that we need to answer. And then if you've seen equity markets and how they've been responding, equities are quite sensitive to any piece of news at the moment. So we're seeing more volatility in the equity markets. Being a multi-asset investor, of course, we're blending equities and we're blending bonds. The bonds bit's probably getting a bit easier. The equity bit is getting harder, but certainly active asset allocation and active manager selection, picking the right managers for the right environment is the big challenge that we have. And that's the bit we spend most of our time trying to get right. So go back to that first slide I showed where you've got the different asset classes. We really want to be able to see that even despite of the current conditions, our balanced portfolio really should be trending somewhere through the middle. But there's a lot of unknowns out there at the moment, and it's very difficult, I think, for any manager to predict exactly what's going to happen in the future right now.
Yeah.
I think I would just finally add that obviously we've spoken a lot about passive, and we really believe in their use within portfolios for that, as I mentioned, that kind of low cost market exposure. But I think that one of the sort of risks with passives that everyone needs to be aware of is that, obviously in time, the last decade, we've seen, a market that has pretty much only gone up. And the whole point of a passive fund is you buy the index, you effectively buy the underlying companies at any price. But passive funds haven't really yet weathered a huge kind of market downturn. And I guess the flip side of buying the index at any price is you would also sell the index at any price. And so it's something to be cognizant of the risks of holding a solely passive portfolio is that in time of extreme market downturns, such as the financial crisis, passive funds have the ability to really accentuate those downturns, and hopefully that's something that we won't see anytime soon. But it's why we believe in a blended approach and think that is a better place for clients to sort of allocate over the longer term.
Thank you. And then we've got a final question, just quick fire answers here. Rob, Olivia, you mentioned your Valeria funds. Can you tell us a bit more about them and where they're available?
Yeah, so this is again, go back to that slide we covered earlier on. Our proposition has evolved over time based on the clients that we deal with. We've been operating in the international advisory space now for just coming up for 3 years. It's been a really interesting journey for us. We've been very encouraged by what we've seen and the partnerships that we've built across Europe and the Middle East. And as a result of that, model portfolios are certainly in their ascendancy. They are being much more widely used by advisors as advisors start on that journey, similar to what the UK went through post RDR in terms of outsourcing. I use that expression, outsourcing, to a multi-asset type investment solution. So model portfolios have definitely are on the rise in terms of their usage by advisors. But of course, there's a lot of environments where client assets may sit where model portfolios aren't available, whether it's within a Curot wrapper or offshore bond wrapper, some of the old legacy style products where model portfolios are not as easily available, and therefore a unitized solution is preferable. And we've had that feedback from a lot of advisors over the last few years that actually, if they could access us on a unitized basis, so all of those ideas Olivia's been talking about that we operate in our model portfolios, that is what we're operating within, building into the Valari International Multi-Asset Fund. So there's 3 risk profiles within the Valari International Funds across 3 different currencies as well, in sterling, euro, and US dollar as well. So we're just in the process of finalising our event schedule, which will run through to the end of this year, which will be a series of webinars and, more importantly, some face-to-face events in various jurisdictions in the Middle East and also in Europe. So anybody on the call today, expect an invitation to one of those events. We hope to see you there, where we're going to delve into the portfolios in a little bit more. And then we're currently working on all that integration with the different providers out there. There's a whole raft of product providers that offer tax wrappers and solutions to the expat advisory market. So we're just going through that process of getting the funds added to all of those solutions so that they can become as readily available to advisors as is possible. Alongside that, we are going through the process of getting the funds registered in a range of jurisdictions as well. Our first tranche of jurisdictions that we're going with are France, Spain, Portugal, Switzerland, Singapore, and United Arab Emirates as well. So those are the first chance of jurisdictions that we're submitting applications to the local regulators to get the funds registered. So as I said, over the next quarter, up until the end of the year, there'll be a lot more information coming out about that. So we will see you at one of our events very soon.
Excellent. And of course, we'll have those funds registered on the platform as well once all the legalities are all finalised. You'll be able to access them through Novia Global too.
Absolutely.
Excellent. Well, thank you so much. We really appreciate your time, Olivia and Rob. I'm sure you'll all agree it's been extremely interesting. Lots of really interesting points and takeaways. You will all get a copy of the slides emailed to you afterwards, and a recording of this has been taken, and that will be available on the Novia Global YouTube channel. If you want access to that or you haven't found it before, then just drop us a note and we'll direct you towards it, so you'll be able to watch it back at your leisure if there was any points that you wanted to recap on. So as I say, it leaves me just to say thank you very much for your time, for joining us. These advisor webinars are for you, and we hope that you find them interesting and useful. The next webinar will be on the 13th of September, and details of that will follow through our Pulse newsletter, which will be out in the next week or 2. Thank you, Rob. Thank you, Olivia. And thank you, everyone, for your time. Enjoy the rest of your day. Thank you.
Thank you.